So if we go back to the book and we see the various payroll, we need to show the total wages of $371, federal income taxes $94,884, state income taxes $15,636, Social Security taxes $28,002, Medicare taxes $53,7950, medical insurance deductions from the paycheck $12,870, and wages subject to employment taxes $57,240. Now it tells us the wages subject to employment tax, 0.8% federal, and a state unemployment tax of 5.4%. Now that's going to be paid on behalf of the employer. Determine the total and components of the monthly payroll, and then we'll have to do the employer's portion of payroll. So we're going to go and figure it out just like the problem we did, where we will take into account the gross wages, and then from there do all the payables, and the net is going to be the difference. So the total payroll is $371,000, correct? We know the federal income taxes, employees payable is $94,884, employees state $15,636, Social Security tax $23,002, Medicare $53,7950, the premiums of $12,870. If you take the $371, subtract from that all those payables, you'll end up with the net amount they need to pay the employees, which is $219,228.50. Okay? Second part's a little trickier. We need to determine what the employer needs to pay. Now we know the employer needs to pay the same amount as Social Security taxes that were withheld from the employee's paycheck of $23,002. We know they also need to pay the same amount in Medicare, $53.79. We know that the federal unemployment is 0.8% of $57,240 in wages, so we can calculate that by 0.008 times $57,240, or $457.92 is payable to federal unemployment. State unemployment is 5.4%, or 0.054 times that base of $57,240. We owe into the state unemployment taxes payable of $3,090.96. Now the portion the employee paid for health insurance was 20% of the total amount. So the way we can figure out how much the employer has to pay in is if we take the $12,870, and we know that's 20% of the whole, we divide that by 20%, we know that the total amount is $64,350. $64,350 subtracted by $12,870 gives us the portion that the employer is responsible for, or as you see here, the $51,480. So the payables for Medicare and Social Security plus the portion of insurance, the federal and state unemployment, total all the expenses of $83,410. That will be the responsibility of the employer. Any questions on that? You guys pretty good on that so far? Make sense? So let's move on to Sorry, guys. The present value is really what I want to cover. We're not going to spend a lot of time. We're not going to talk about product warranty. A lot of that, you're going to continue with all of these concepts in a greater depth in future classes. So there's certain things I'm just not going to get into. But what I do want to talk about relate to fair value accounting. So you will have a homework problem similar to this, so we're going to go over to this. What is fair value? It's the price for which an asset or liability could be sold or leave the company. Fair value, there's three ways to approach it. One is called the market approach in valuing investments and liabilities, or you could do the income approach relating to future cash flows, or there's what's called a cost approach. When we relate to fair value, it's important to be aware of the time value of money. As money is sitting, burning a hole in your pocket, because we have an interest rate, or due to inflation, small inflation right now, interest rates, money can always be making additional money, or debts continue to increase as far as the interest that you pay on debts. But $1 today, because of inflation, generally is going to be worth more than $1 a year from now. Because generally speaking, prices go up. So if prices go up in cost, then money also, today's value of that dollar is going to be greater than what it's going to be down the road, just due to inflation. Interest is the cost of using money for a specific period. Now, when we're dealing with what we call simple interest, we just take the interest rate and add it to the take it based on the value of the loan. We don't add interest to the loan balance. But oftentimes the compound interest rate is what we're familiar with, where the interest of 2 or more periods, when the principal sum gets increased at the end of the period because of the interest. So let's say you don't pay your car loan. Your car loan doesn't stay at that same amount. It usually has the increased interest that you forgot to pay. And then you're paying interest on that balance that now includes interest. The amount of principal plus interest after 1 or more periods is known as future value. Simple interest is the interest cost for 1 or more periods when the principal stays the same period after period. It's kind of how we computed it when we went over those problems. Willie Wang accepts an 8% $15,000 note due in 90 days. How much will he receive at that time? The interest is calculated by taking the principal amount times 8% times 90 days divided by 365 days in a year, or Willie would receive in interest for 90 days $295.89. So when Willie gets paid, he's going to get the $15,000 plus the interest of $295.89. Now, if we compound that interest, then after each period, the interest that was earned gets added to the principal that's owed to the individual. So in this case, as you see, Terry deposits $10,000 in an account that pays 6% each year. She expects to leave the principal and accumulated interest in the account for 3 years. If the interest is paid at the end of each year and is added to the principal balance, and this amount in turn earns interest, how much will Soma's account total at the end of 3 years? So this is compounded interest. We start the first year with $10,000. At the end of the year, she's going to make 6% on her money, or $600. So at the end of the year, instead of her balance being $10,000, by compounding it, it's now $10,006. So as she goes into year 2, she's going to get interest not just on $10,000, but $10,600. So she starts year 2 by a new balance of $10,600 times 6%. Do you see, instead of just making $600 on her money, because the new balance is $10,600, she now gets $636 of interest. She's going to add that $636 onto her balance in year 2 of $10,600. So at the end of the year, her new balance sitting in the account is $11,236. So in year 3, she starts getting interest on $11,236, which is $1,236 greater than what she started at. She then gets a 6% interest rate on that new balance, that compounded amount. That's equal to $674. After the 3rd year, she's going to receive $11,910.16 if she were to take her money out now. She's got that amount in her account. The amount of interest increases each year by the interest rate times the increase in the interest that was received in the previous year. So between year 1 and 2, the interest went up $36, which equals 6% times the amount of interest she earned, or $600 in interest times 6% was the $36. So compounding your interest basically is how people make money, because if they let it sit, you're not just getting interest on that principal balance, but you're getting interest on that interest that's been sitting and adding to it. Present value is the amount that must be invested today at a given rate of interest to produce some value in the future. So, here's a good example. Lucia needs $10,000 in 1 year from now. How much does she have to invest today to achieve that goal if the interest rate is 5%? From earlier examples, we can establish that the present value times 1 plus the interest rate equals the future value. So the present value times 1.05 needs to equal $10,000, because that's how much she wants in a year from now. Which basically, you take that 1.05, divide it by both sides. So $10,000 divided by 1.05 means she needs to invest right now $9,523.81 at a 5% interest rate in order to come up with $10,000 in a year. Does that make sense? So basically what we're doing is we're trying to figure out what is the right valuation we need to show today in order to have a balance of $10,000 to be received in a year from now. So this is where valuation is important, as we're talking about how do we report in our financial statements the present value today on our books of money that we want $10,000 in a year from now. That's why present value is important. And that's why it's important to know what's the interest rate going at. Because we're only going to be good at predicting our accurate valuation today based on what we believe the interest rate is. So as you see here, to achieve a future of $10,000, Fontaine must invest a present value of $95,2381. Interest of 5% on that money for 1 year equals the $476.19, which ultimately then will give her $10,000. Does that make sense, guys? The present value of a single amount of cash is the amount to be received at a specified date in the future. So here we've got Ronnie. Ronnie wants to make sure of having $8,000 at the end of 3 years. How much money does he need to invest today in a 5% savings account to achieve this goal? How are we going to figure this? So at the end of year 3, he wants $8,000. So we need to divide that $8,000 at a 5% rate, divide that by 1.05, which means at the beginning of year 3, he needs to have $76,1905. So at the end of year 2, we know if he's going to have $76,1905, we need to divide that by 1.05 to see what he needs to start that year with. What he starts that year with, or ends that year with, I should say, or starts that year with, is what he ultimately ends year 1 with. Divide that by 1.05. He needs to invest $6,910.70 today at a 5% interest rate in order for him to get $8,000 at the end of 3 years. So basically, the way we're calculating this is we take the end goal, and if we take that, divide it by 1.05, come up with a new figure, that means this is what he'll need at the beginning of year 3 to end up with 8. If he needed this at the beginning of the year, then this is what we know he needs at the end of year 2. And we can calculate how much needs to be invested today at 5% in order to calculate what that $8,000 is going to look like down the road. We can simplify the calculation by using a table. Look at Table 1 in Appendix B. So let's go back to Appendix B. And look at Table 1, which is on page 1150. Let me pull this up right here so you can see it. Whoops. $11.50. It doesn't like my page. Do you guys have a different page? Okay, I'm sorry. I must have the teacher's edition. So do you see this chart shows, instead of us creating all those calculations, we can use this chart and say, how much do we need to invest today at a 5% interest rate to have X amount of dollars at the end of 3 years? If we know our period is 3 years, we know the interest rate is 5%, then we're going to use this figure, 0.864. And whatever that amount is, $10,000, we can take 3 years times 0.865 to determine how much we need to invest today. So in this case, present value of $1 to be received at the end of a given number of time periods. So we would need $8,640 at a 5% interest rate to end up with $10,000 at the end of 3 years. So that table will save a lot of time. As you see here, in this case, they're saying we want $8,000 at the end of 3 years. So we're going to use that same period 3, 5%, 0.864. We're going to need to invest $6,912 today at a 5% interest rate in order to end up with $8,000 at the end of 3 years. Does that make sense? Now, there's different kinds of annuities, or present values. There is something called an annuity where we have to calculate how much we need today, but instead of getting a lump sum at the end of 3 years, we're going to get a fixed amount each year. So it gets a little more complicated. An ordinary annuity is a series of equal payments or receipts that begin one time period from the current date. So here's an example of what's called an ordinary annuity. Vicki Long has sold a piece of property and is to receive $18,000 in 3 equal annual payments of $6,000 beginning 1 year from today. What is the present value of this sale if the current interest rate is 5%? So basically what we're trying to find, she's going to get $18,000, but she's going to get $6,000 of it in 1 year from today, $6,000 in 2 years from today, $6,000 in 3 years from today. What is the present value of that money she's going to get in the future? So as you see here, we will look at the present value factor at 5%. If you go to that Exhibit 3 in the book, then it will calculate and give you the chart for future receipts, present value of a factor, future receipts, present value, received each period for a given number of periods. If we look at Table 2, and we're looking at 5% over 3 periods, then, actually it's not Table 2, Exhibit 3. Let me look in our book for Exhibit 3. Which would be on page 428. So if you go and look at 428, will show you a portion of the table that says 5% present value of dollar to be received at the end of a given number of periods. No, that's not correct. I'm sorry. 6,000, 6,000. An ordinary, okay, we're going to use that same table. I was wrong. So if we know that we're going to receive $6,000 each year, what we're going to do then is we're going to use the table, but we're going to make it, there's another table we can use. But for now, if we know at the end of year 1, we're going to receive $6,000, we can go to the same table we're working at and say, what's the present value of $6,000 today in a year? Okay? So we go to that table and we look at 5% year 1, and it tells us 0.952 is what we're going to divide that $6,000 by to know what the present value of that $6,000 is in a year. Then at the end of year 2, we know we're going to get another $6,000. So we're going to look at that table again and we're going to say, okay, at 5%, in 2 years we're going to be getting $6,000. What is that present value today? In 2 years from now, we're going to be getting $6,000. So we go to year 2, 5%. It'll tell us multiply that amount by 0.907, which is $54.42. Then it tells us in 3 years from now, we're going to be getting $1,000. So we take the chart, year 3, 5% interest rate. It tells us to use 0.864. So this is the present value of the money we're going to receive in 1 year from now. This is the present value of the money we're going to receive in 2 years from now. Here's the present value of the money we're going to receive in 3 years from now. So today, the present value of all those payments is $16,338. So we basically have interest of $1,662 that we are taking into account. So this money is worth $16,338 for money of $18,000 we're going to receive by taking $6,000 in year 1, $6,000 in year 2, $6,000 in year 3. So we did this, it was a little more involved this way because we had to take those payments instead of getting one lump sum at the end, we're getting a fixed amount after the end of each year. So if we go to Table 2 at the back of the book, we can make it a little easier. What we can do is instead of calculating each payment on its own, we can go to the chart, and this chart is for the present value of an ordinary annuity, which means we are going to get those amounts each year. So if we go and look at this, and we know the amount is $6,000, and we go to that table and take 5% over 3 years. Do you see we can go down here to period 3 at 5%. We can take that $6,000, multiply it times this portion on the table, 2.723, to give us the exact same number we just calculated. We need 16,000, or the value of that money is 16,338 today. Okay? So there's a lot we could talk about here, but that's the main thing I want to focus on. The reason we need to talk about present value is in order to accurately report our finances correctly on our financial statements, we need to be aware of this concept of present value. So when we're dealing with getting a note down the road in 2 years from now, and we know we're going to get $10,000 in 2 years, we're not going to show that on our books today at $10,000 because it's really not $10,000 today. It's really a lesser value because the value of $10,000 in 3 years from now on our books would be less today. So that's the key in when we calculate our assets or specifically liabilities, what we may receive or what we may owe down the road. It's going to be calculated using the present value. Here's an example. The present value of an asset is based on the saving it will generate over its life. Mike Yebo is thinking about buying a machine that will reduce his annual labor cost by $1,400 per year. The machine will last 8 years. The interest rate that Yebo assumes for making equipment purchases is 10%. What is the maximum amount that Yebo should pay for this machine? So, you see, it's going to save him $1,400 per year over the next 8 years. See, he plans on saving $1,400 each year. After year 1, after year 2, after year 3, after year 4. Do you see what I'm saying? So what we're trying to decide is, to buy this machine, he's going to save money. But what's it really worth to him to purchase this machine? We've got to see, what is it like not to buy the machine and just have labor? And then, what's it like to buy the machine? So if we show he's going to get $1,400 in savings at a 10% interest rate for 8 years, we'd go to Table 2. And we would look at a 10% interest rate over 8 years. If you look at that section, we should be able to see 10%, 8 years. If you look down at that, do you see how we show 5.335 is the factor we use? So $1,400 times 5.335 means today's value of that money is $7,469. So he shouldn't pay more than $7,400 on that machine, all other things being equal, to save $1,400 a year. Does that make sense? Because if he's trying to do a cost analysis of, by buying this machine, I'm saving this amount of money, we really need to look at today's value of that money to see what he should purchase that machine for in order for it to be a better decision, a beneficial decision. So, if we go and look at problem let's look at E9A. E9A. It tells us find the present value of a single payment of $12,000 at a 6% rate for 12 years. So let's look at Table 1 and find 12 years, 6%, and then we'll find out what the present value of that $12,000 is going to be. So do you see 0.497? So if we take $12,000 times that 0.497, that means the present value of $12,000 in 12 years at a 6% interest rate, the present value of that amount is $5,964. The next one says, what about finding the present value of 12 annual payments of $1,000 at 6%? So we're going to go to Table 2 because this is not a lump sum. These are annuities, an amount fixed each year. So we're going to go to Table 2 and look at 12 periods at 6%.
What's the difference between
I'm sorry?
the difference between Table 1 and
Table 1 is for a lump sum. Table 1 is we want $12,000 in 2 years from now. Table 2 is we want $12,000 every year for 12 years. So the charts have to work different because you're pulling out some of that principal. Okay?
So would that be like the same thing if you won the lottery?
Yes.
And they pay you once a year?
Exactly. That's exactly the same thing. You are basically receiving an annuity. Sometimes you have an option between a lump sum up front, which is going to be a lot less, or an annuity of a certain amount each year for so many years. Do you see why that lump sum is less? Because you get it all up front. Now, what would you pick? I'd pick the lump sum if you have the choice. A bird in the hand is worth more than two in the bush, right? Never understood that. I get it. So if you look at number 2, you're going to look at the chart and take 8.384, so $1,000 times 8.384. That value of $1,000 over 12 years, the present value of that amount today is $8,384. You're going to do the same for 3 and 4. You're going to use table 2 for number 3 and number 4 because, again, we're dealing with annuities. We're dealing with an amount every year. A single payment of $2,500, oh, excuse me, number 3 is not, number 4 is. A single payment of $2,500 at 9%, oh, but for 5 years. But it's a single payment of $2,500. So it's a one-time payment of $2,500 for 5 years. So that one, in that case, is going to be, I was wrong, table 1, because it's a single payment at the end of 5 years. So you're going to look at the interest rate of 9% in year 5, and you're going to calculate, you're going to see the formula to use, 0.65 times that 2,500. Then the last one is going to be an annuity. It says 5 annual payments of $2,500 at 9%. Do you see 5 annual payments like the lottery? You're going to use table 2 because it's an amount each year. If you go over to table 2, it's going to tell you to use 3.89. That times the 2,500 means the present value of those monies over 5 years is $97.25. Any questions on that? Does that make sense?
Yes. But there is a way to find these numbers. If you have,
I'm sorry?
to find the 3.890, the factor self table.
If you did that, the way you would do that, we would go back, so 5 annual payments of $2,500. So what you would do is similar to this, we saw this on this PowerPoint slide. Let me find it.
Yeah, I know you talked about it, just kind of forgot.
Okay, so what you would do, instead of using the table, what we would do, okay, here it is. We would go out and show, here it is. Wait, where is it? This one. No. This one. No. This one. We would show 2,500 year 1, 2,500 year 2, 2,500 year 3, 2,500 year 4, 2,500 year 5. We would take table 1 and say, what's the present value of $2,500 in 1 year from now? Okay? So we would figure out the present value of 1 year based on that interest rate, come up with that present value. Then we would say, okay, what's the value of $2,500 in 2 years from now? We would calculate that. We would do that for year 1, 2, 3, 4, and 5, come up with those present values, and then add them all together. The easier way is to use table 2. Does that make sense? So what you're going to be doing in your homework assignment for problem 5
is Austin Corporation enters into a purchase agreement that calls for a payment of $250,000 3 years from now. And then they bought out the contract of a member of a top management for a payment of $25,000 per year for 4 years. You're going to have to use the tables. Assuming an annual interest rate of 10% and using those tables, what's the present value of A and what's the action for B? It's just what we did by using those tables to determine, based on that, let's figure out today what the present value is.
So what I want you to do for homework